Okay, we're going to get started with the S&P 500 like we usually do. It's hard to believe, but from this time last week, we're actually up, but it seems a lot worse than that. Um, we're currently up 2.5% since last week, thanks to a 10% rally we had. It's basically what's happening right now is we're in a defined downtrend, and this is all the pieces to a bear market rally. We um, we are zigzagging down, and we went up 10%, and we're in the process of going down half of that on Thursday. So it seems like we're approaching earnings season. Let's look at the sunny side of things. We're in the middle of April now, and we're going to begin earnings season with J.P. Morgan and the banks. So a lot of times when there's earnings that come out, that could allow the stocks to appreciate some. But this is not normal times. We are in a we're in the midst of a worldwide deleveraging credit risk issue right now. I'll go over that a little bit later. I've been mentioning for the past month or two or more that there's been a major problem with borrowing money and credit risk right now. We have a lot of smart people that are telling us that we have to be more conservative with our investments because it's becoming evident that there's blow-ups in the world, and there are people that borrow money and the trade goes against them, so they have to liquidate. That is seemingly happening all over the place. Okay, so basically, you can see that we corrected in a major way down this time last week. We were down 5% 2 days in a row, and we opened on Monday down. Um, so you can see that we have extreme volatility. This was based on tariff comments, and we have a situation where we are actually um, progressing in a downward channel. Let's look at our chart. Our chart basically kind of maps out this downward channel we're in right now. We're kind of, when we had a 10% rally recently, we kind of hit the top of that channel almost, and now we're kind of zigzagging down. So this is this 10% up move is called a bear market rally. And we're going to look at some of the comments from some people on Twitter, and just to kind of explain what's going on right now. First of all, we're going to look at Michael Guyad. He's been saying for quite a while that there's a carry trade that's happening in the world. We have major hedge funds, maybe central banks. They're basically borrowing in Japanese yen and their no Japanese money, and they're buying the Mag 7. And the Mag 7, whenever the interest rates in Japan go up and the yen, um, what seems like what's happening right now is we're having a lot of leverage towards a trade where they borrowed money foreign in foreign countries that have a low interest rate, and they're buying in a major way. They're leveraging and buying stocks. And whenever the interest rates go up in these countries, that forces a lot of liquidation. So there's a lot of liquidation going on right now. We're going to see what Michael says right now. He says we may be in the midst of the greatest deleveraging rug pull of all time. So that's pretty scary. Um, so as an investor, you have to understand that there's a lot of forced selling, and sometimes stocks go down, and it might not make sense, for their true value. And but there's a lot of pieces coming together now that are leading towards a great event, some kind of credit event. We had a credit event in the year 2008, and um, we saw a lot of companies going bankrupt and companies that were big companies like Lehman Brothers that went under. So we haven't seen any evidence of this yet, any major names, but there's been some talk that there's been some high-level meetings with the administration, the current administration, about how to handle deleveraging. So keep that in mind because there's a very good chance that we'll continue this downtrend. Let's look at some more comments from people. Okay, Dougie Cass. He basically said Wednesday was likely a rally in a bear market. So we see this 10% up day. You see, he thinks that's a rally. We're in a protracted bear market. In other words, we're going to be in a downtrend and not in an uptrend like we've been in the past couple of years for quite a while, according to Dougie. We're in early stages of a protracted bear market that started in late January 2025. Valuations remained inflated. Consensus EPS and global GDP forecasts are too optimistic. Recession risks are probably still close to 50%. Federal Reserve is dug in a policy box. That means the Federal Reserve can't raise interest rates because tariffs are good potential catalysts for inflation. No, they can't reduce them. They can't reduce the interest rates because of potential inflation from tariffs. But they're still in a situation where the economy is going to be contracting. So that's why they're in a policy box. Over history, the best daily returns are achieved during bear markets. Yesterday was probably no different than the previous bear market rallies. Okay, so you can see these. Let's look at it. That's not the one we're looking for. Okay, these are the best rallies of all time. 10, 13, 20, 28 is 11%, 10, 28, 20, and 28, 2008, 10%. These are all in bear markets. And in other words, right after this happened, it kept on going down. So let's look at more things he's saying. We continue to view January 2025 as an important market and Mag 7 top, similar to the major market and Nifty Tip 50 tops experienced in January 1974. We expect a possible retest of the recent lows. Let's look at the SPY. You can see we were down to 500 in the S&P, 5,000 in the S&P during the first correction last week. So if you go do a quick calculation, 500 divided by 524, that's 4.5% from where we're at right now. So he thinks we're going to retest. But a lot of times whenever you have a major crash like that, there's a lot of power involved if you go down to that level and you bounce. And that's a good indication that you have like a floor on the stock market. It's not 100%, but that's what he's saying in this article. Let's go back and see what he's saying again. Improvisational fiscal policy and changing goalposts of reciprocity with trading partners, driven by impulse, intuition, and little analysis, will likely weigh on spending intentions in the global economy. So, in other words, Trump's tariff um, debacle is going to make the global economy slower. Um, where people tipped off to yesterday's announcement, there's a lot of people that bought options right before the rally, and they're saying that they might have known about the tariff information. We sold out of most of our trading long rentals in the spectacular rally late Wednesday. Okay, so basically, what he what he did during this rally, he saw it as now we're tracing this lower highs, lower lows right here. He saw this. He knew we were in a bear market going downwards. Whenever it goes up to the top of this range, that's a sell for him. And when it gets to the bottom of this range and people are despondent, that's a buy. And that's how he's making money in this market. Okay, so basically what he did on this worst day, he was buying Microsoft, um, Google, large cap companies, and in while everyone else was selling in a major way. And he was buying SPY, QQQ, and what he did was he rode because the it was oversold so much, he rode that up, 10%, and he sold right here. So his way of making money in this environment is whenever everything is so oversold, no one has any faith, and um, he buys them. So let's look at some more of what he said. That's all I said. Okay. So keep in mind that you got to have a theory when you're investing. Right now, there's a lot of people we'll be going over that are saying that you need some cash, a cash position. Like Dan Niles at the beginning of the year, he mentioned 25% cash is going to be important. So um, let's look at some of our talking points. First of all, let's look at our charts. These are the ETFs. Almost every one of them is in a downtrend. You can see this downtrend here, except for gold. Look, it's hitting an all-time high, and not all-time high, but it's been the only thing that's been working this year in our charts. The reason why gold could be working is um, there's a lack of confidence in America, and there's a lot of weird things going on with drops in the stock markets around the world, tariffs, and whenever there's also the dollar is going down, and also we have a lot of uncertainty in America. People used to buy the U.S. Treasury whenever the times were tough around the world, but now looks like the United States is losing their safe haven for investors around the world, and people are gravitating towards gold. Another reason why gold could be going up, central banks around the world could be dumping the United States treasuries because of the debt situation in America. And if that happens, what are they going to do with their money? They're going to put it in something that will retain its value over time. And so that could be a reason why um, investors around the world are buying gold. So there's a lot of smart people that are saying that a certain portion of your money should be invested in gold. We're going to go over that a little bit later. Okay, let's look at some more of our talking points. What do we have to look forward to in April? We have the tech earnings coming out in just 2 weeks. We're going to have um, tech companies that are helped by the US dollar going down. They're going dollar is down about 10% this year. So that's going to help the earnings of the multinationals like Facebook, Google, um, maybe by up to 3%, because that's what Morgan Stanley said, 3% earnings adjustment for every 10% move in the dollar. Okay, let's look at um, let's look at our next talking points. It's amazing that with all this volatility, we're up actually 2.5% from last week. We had two down days, Friday, that was Thursday and Friday, down 5% each. So we've had capitulation last week, and we had a snapback rally at the beginning of this week. Um, so we see that the yields, oh, I'm sorry, this is wrong. The yields are up in a major way this month, this week. Let's look at the yields. You can see it's quite strange that the yield of the 10-year went up so much. And there's a lot of smart people like Jeffrey Dunlop that are saying that there was forced liquidation. So that whenever I brought up the carry trade and people borrowing against foreign currencies and blowing up, that could have been what happened there. It could have been Japan having to sell some of their securities to support their um, dollar denomination, yen. Okay, so we don't know, but something's weird is happening um, where there's not a whole lot of demand for the U.S. 10-year Treasury. So what this means is there's something major going on that we don't know about that could blow up in any day and cause the stock market to go down and risk assets to go down. So you have to be ready for that. Okay. So what else do we have to know? Okay. Whenever there's a stock market craziness, seasonality doesn't work. It's just all out the door. And same with stochastics. The beautiful stochastics we knew for multiple years where you sell on the high and you buy on the low, buy when the stochastics are low. Nothing works whenever you're in a protracted downtrend. Um, well, I guess it does. If you're actually looking at oversoldness, if it's oversold and it's the bottom of this channel, downward channel, then you could go up. So, um, so I was wrong there. So it does work, but it's not as fun when your stocks that you're looking for is going down. All right. So we are oversold and we're still going up. And we're below all moving averages. So every single moving average is so far away, there is no support in the stock market right now. Um, let's look at the S&P and try to map out some levels of support. We mentioned this level right here where we're at right now as a level of support because this is whenever a past time when it went down. This is last August. Here's another level of support, and that is where we corrected to during the crash last week. And now this is where Jeffrey Gundlach says we're going to um, make sense for a fair valuation for the stock market. That is right here. That's at 450. And we have a support right here where we stopped and went up in the past. So it's we're in a protracted bear market, it seems. And let us go over the US, the 10-year Treasury. Okay, you can see that the story is here that as the US 10-year goes up in yield, it seems like the S&P is following it. almost perfectly correlated. And I guess you can interpret that as you have, if you have well, this is becoming, um, hmm, if the 10-year Treasury goes up in yield, then there's usually a strong economy, but there's signs of weakness everywhere. So all of that correlation doesn't necessarily work anymore. We just have some forced liquidation right now. A lot of times, whenever the stock market goes down, the US Treasuries are the first thing that people buy. So the yield goes down in a crash. But that is not happening when there's market turmoil in the world, too. All right. So that's something that we don't understand. There could be some forced liquidation that's just beginning. And if that happens, if there's more forced selling of the US Treasury, like if Japan and China start liquidating, then interest rates will start going up, and that messes everything up. We have debt that's due in the United States. It could be, and we're spending more than we have. We just announced a $1.3 trillion deficit this quarter. Um, they're just a major problem with the United States debt right now. Okay, let's look at some of the variables in the stock market. Um, oil is down 11% since last week. And I guess the good reason for that is slowing economies. Um, the tariff situation with the president has slowed the economies around the world in a major way because companies don't invest in employees whenever they have to worry about tariffs and uncertainty of whether tariffs will happen or not. And so a lot of companies could be firing people. There's a lot of companies that won't build a factory because of a potential tariff they don't know about. So there's going to be like a standstill in economic activity around the world because of this tariff situation. Um, okay, so let's look at some more things. Okay. Okay, we have inflation cooling. We just had a report out that said inflation is cooling. It's 2.39%, and it was 2.82% last week. Only problem is with tariffs, the prices are going to be going up. So um, I'm sure this inflation will go up as tariff dynamics hit the market. The US dollar index is down another 1%. Let's look at the chart of the US dollar index. It's down again, 1%. So it's down. It measures the strength of the US dollar against a basket of other currencies. As the dollar index go down, commodities go up. That's another reason to buy gold. And that's another reason why gold is up 2.8% this week. So as the dollar goes down, so it's making a lot of sense to buy a portion of your portfolio in gold. Um, the situation with the government of the United States spending more than they have, um, uncertainty around the world, we have deleveraging, and um, the easiest way to buy gold is to buy the ETF GLD. So that is this one right here, GLD. And we're overbought right now with gold. If we look at our stochastics, you can see that no, we're actually, I guess we're overbought. Let's look at that up close. It's at 37, so it's actually oversold, starting to go up in stochastics. But let's look at the actual, it's hitting an all-time high. So, everyone's buying this right now for protection, it seems, and for other reasons. So let's look at, okay, the dollar index is down, and that's going to help all of the multinational companies this earnings season. So the tech companies are going to get a 3%. The US dollar is down 10% this year. That means almost all the multinational big tech companies will be 3% better for the earnings because of foreign currency headwinds. Let's see. Last week, okay, so let's look at. Okay, so a stronger US dollar tends to drive prices lower of gold, and opposite, a weak US dollar sends gold prices up. So that correlates, that makes sense. Um, Fear and greed index, we're off the charts, fearful. Um, and right now there's fear in this chart, and there's also fear in the VIX, which is 40. It was at 50, 60 during the crash last week. Um, the AAI survey, the Amateur American Association of Individual Investors, bearish 58%. So how many weeks in a row has there been more bears than bulls? This is a record. This is for the time it goes back. Wow. Goes back at least half a year of more bearish than bullish. Wow, it's amazing. No, only goes back to February 5th. But people are very scared right now. We have panic in the VIX. Right now, the 40 level is a panic crash. People are afraid and they're buying protection. We're in our emotional graph. We're definitely in capitulation mode on a regular basis. Now we were listing these things that could cause a crash, and a lot of these things are actually coming to fruition all at the same time. We have the Magnificent Seven overvalued. They're actually going down the most compared to the rest of the market. There's a lack of confidence in the AI story. The economy is slowing down, and there's a lot of smart people like Jamie Dimon from JP Morgan saying that there's a greater possibility of a recession than not. And a lot of people are saying that there's a 60% chance of a recession. So there's going to be layoffs in not only companies, but government layoffs are slowing the economy. Weak dollar brings up the cost of commodities. We know that. Um, Random Trump actions are word. The tariff situation was just totally off the cuff and totally affected the stock market. It made it crash. So it seems as though, as an investor for the next 4 years, we're going to have to put up with this craziness every day and from the president. So, let's see, higher yields on 10-year Treasury could cause a crash. Will there be buyers for U.S. debt? If no, rates will continue to rise, causing problems. We could go bankrupt as a country if the rates go up substantially from where we're at right now, because the amount we're paying right now is maybe 10% of our GDP. And if interest rates go up like what they're happening right now, what's happening, we could very well have a problem where there's a lack of confidence and we could have a bankruptcy situation in America. That could be the major problem that happens. Let's go back to this chart. We've been looking at this same chart for what seems like a year or two. I charted out the actual values for each of these. Okay, this is a 4% yield. See, the blue line is the yield of the 10-year, and the red line is the S&P 500. No. S&P 500 is the blue line, and the red line is the yield of the 10-year. So you can see that the last times that the 10-year, which is red, was 4% yield. The S&P was at 16 PE. You can see right here, see, you can see the 16 PE right here with the 4% yield. 16 PE, 4% yield. So it looks like we're going to go down to a 16 PE in the S&P 500 if we have a crash situation. And that's 15% from right now. That's 25, yeah, it's 25% from where we're at right now. According to the Wall Street Journal, we're at a PE of 22 still after this big correction. And so that's 25% less than we're at now. All right, so that's the example of return to the mean. We've been saying that since the beginning of the year and since the beginning of last year. Our theme this year is investors will be reaching for stability amid chaos. Investors preparing for a slowdown in the economy, possible recession, and chaos. Utilities, healthcare, consumer staples were our theme from the beginning of the year. And look at this year. The worst from last year are turning out to be probably the better performing from this year, except for energy. Energy is down because of the economy around the world have been majorly affected by the tariff situation. So there's going to be less tractors and everything, less cars driving around in the world when the economy is slowing. Um, okay, so let's look at our worst to first. The best from last year are down um, 18% and 10%. The worst from last year are actually up. Let me see, materials is minus 6%, but consumer staples like Tide and um, bath tissue, that is up 2.42%, probably one of the best sectors. Healthcare is down only 2%, and real estate down 6%. Utilities are probably one of the better sectors, only down less than 1%. Okay, so our worst to first worked for last year. Um, let's look at some of the market movers up and down today. No, yeah, today. Okay, look at that. Newmont Mining, that's gold manufacturer. They actually mine gold. Kroger, these are all safe haven plays. Companies, Kroger is a company where people buy the food regardless of price because you got to eat, and they pay a dividend. We have American Waterworks, a utility, United Health Group, healthcare, Consolidation Edison, their utilities, Cigna Group, healthcare. So if you see all these top performers, they kind of match our theme from the beginning of the year, which healthcare, consumer staples as the better sectors to buy. And the ones performing the worst, we have chip stock, a microchip, a oil company, um, United Airlines, Delta Airlines. Okay, a lot of discretionary stocks that you don't necessarily have to go on an airplane ride, but you do when you're feeling good. That's the example of discretionary purchase. Um, energy. Okay, so the price of oil is going down, and that's the reason why a lot of those are there. Um, let's look at the NASDAQ, Electronic Arts. A lot of very conservative stocks here. We have Exxon, a utility. We have a gaming company, O'Reilly Automotive. I guess that O'Reilly Automotive is why would O'Reilly Automotive be in a top performing stocks today? Think about it. I'm thinking the rationale is with the tariff situation unknown, people will not be buying cars as new cars as much as before. So if the price of the car goes up because of Mexico and Canada tariffs, um, and overseas tariffs, people are going to be fixing their existing car a lot more and not buying a new one. That could be why O'Reilly is up. Ross stores. Why would Ross stores be up today? Um, well, we have, mm, why would why would they be up? Well, they make money whenever there's a high inventory levels of companies and they have to get rid of their inventory. There's been a lot of pre-ordering in companies because of the tariff situation is unknown. So a lot of people are pre-ordering and getting a lot of inventory. Maybe that's why they market the discounted goods from other places. Let's see, American Electric, utility, Dexcom, they do healthcare for diabetes. T-Mobile, we mention this every week. They have a United States-based environment. Most of their money comes from America, so they're they can grow without being affected by global events. And Costco, why would Costco be stable today? Um, Maybe that's because they have 99% renewal biz for their business. They're raising their cost of membership, and people go there to save money whenever they're uncertain. And so you have a very stable business, even though they're very expensive. One problem with Costco is one good thing about Costco is they can choose their stuff that they sell from around the world. They're not fixed like Walmart to offer everything that you can buy at the office or every type of clothes. They can buy unique things that they get on sale from Vietnam or a better tariffed country. So that helps them maneuver in this environment. So that's another reason why Costco will be doing good. And we have Excel Energy, of course, they're a utility. Um, I don't have anything to say. Oh, MicroStrategy. This is probably one of the riskiest stocks that I've ever seen. This company buys Bitcoin, which is a worthless um, entity. They buy it on margin. They actually borrow money to buy it, and they're totally at the mercy of the price of Bitcoin. So if the price of Bitcoin goes down, they go down exponentially, and that's exactly what happened to them whenever we had this crash this past week. Let's look at the quote from MicroStrategy. They're down 8% today, but they're taking a huge gamble on the price of Bitcoin. You can see that, hold on, let's look at the 1 year chart. Okay, so this company is famous for, they used to have a cash on their balance sheet, and instead of holding cash, they converted it to Bitcoin. And now they're one of the largest Bitcoin holders in the world. And because of that, they're at almost 4-to-1 correlation to how Bitcoin goes up and down. So if Bitcoin goes down 10%, this company's going down 20% because they're leveraged. It is not a good idea to buy this stock. Okay, so all right, so let's look at, okay, that was a good excursion. Look at some of our talking points. Okay, Dan Niles picks from the beginning of the year. We see, okay, we see ADTN down 9%. Costco only down, Cisco only down 4%. IJJ, that's been a loser, down 13%. KWEB, the Chinese tech ETF, down 15%. And cash has been his best idea. It's up 4% while everyone else is losing. Okay. Let's see. All right. I'm not gonna I'm not going to say this again, but if you get this document, read this over a couple times because we're basically, if the government is reduced in size for employment, and if there's less spending by the U.S. government, um, there's going to be a lot less um, good earnings reports coming out. So keep watching that. Here's a little story. Let me see. Rats. Okay. That didn't come out very well. The picture. All right. So let's look at our um, emotional graph. I was trying to figure out where we're at. We're probably right here at the pre-panic stage. When we have a down 10% day, that's a panic. But we're basically right here right now where we went up 10% this past Thursday. This is exactly what Dougie Cass was saying about a protracted bear market. People get super excited whenever we have these snapback rallies, and they think, "Oh, that's it. We're out of the woods." But in reality, we have this maybe another downtrend. So let's keep that in mind. Whenever the stock market goes up, you know, it's not necessarily the people think it's a good time to buy. There's a lot of deleveraging, there's a lot of forced buying, and there's a lot of shorting and a lot of market dynamics forcing that makes these big rallies happen. But just understand, we're in a bear market now. We're not in the 2 year bull market we've been in for the past couple of years. All right, so let's look at. I just like to look at things that could help the situation. This guy pointed out, and I tried to do the same chart as he did. Um, since the COVID lows, we're basically, if you trace all the bottoms, we're actually at a support level for that. So let's hope that holds, because it's been a long time, and that's probably one of the only kind of levels of support that we have right now in the stock market. This has been a total mess, this tariff situation. I didn't get to talk about a whole lot last week, but when Trump announced tariffs, it just screwed every business model from around the world, not just American companies, up. So the cost of goods sold is a major part of doing business. And companies, when they're jerked around, like the president has been saying, where tariffs are on, tariffs are off, tariffs are on, this totally affects how companies source their materials, and it could lead to this whole debacle could lead to a lack of confidence in the United States. And that could totally affect our treasury situation and our debt situation. Okay, so here's some charts of interest. We already looked at the gold chart. It's just amazing. It's hitting, highs at the top of its range. It's in this upward zigzag. It probably could go down to here next, and then it'll go back up to here. Um, Consumer staples select. Okay, this is in a sideways pattern, and it's paying a dividend. It doesn't grow. These companies aren't growing that much, but they do have a dividend, which is very important in this environment. Berkshire Hathaway, look, it is almost hitting all-time highs. They are famous for selling off their half of their Apple position last year at the highs when everyone else was, you know, caught up in thinking the Mag 7 will go up forever. But they're sitting on 324 billion in cash right now. And I'm sure they're going to be buying quality stocks in the market downturn. eBay, look at this. It's in an uptrend. It broke out just a little bit from that, but it still seems like it's in an uptrend. Now, why would eBay be up? maybe as the price of things from China go up, maybe double in price, or maybe up 20 or 30%, people are going to want to buy used things more. For instance, if the iPhone, with the current taxation, it's going to go up in price. People are going to buy a lot of used iPhones. So that's just an idea. Eli Lilly is kind of in a sideways pattern. It was in an uptrend all last year, but it's at the bottom end of its range and it's oversold. So they have the best weight loss drug in the world right now, and it's selling like gangbusters. It seems like they're going 30 or 40%. And you can't get it. This is like the almost the perfect chart of always hitting this low and bouncing. And we're oversold right now. Here's another interesting one, Costco. It's basically one of the only charts we're watching, like T-Mobile, that's in an uptrend. And it's overvalued. It's like a peg ratio of 3 or 4 or 5 or more, but it's consistent, growing 11%, even if its PE is elevated. All right. Here, I thought it'd be appropriate for me to go over a playbook for surviving market crashes. Whenever your stock market goes down in general, um, you have to know if the event causing the crash affects your position in a 1 year, 10 years. Okay, so first of all, in this situation, we have a tariff announcement. We don't know how long those tariffs are going to be on. Is it going to be a day, years, months? Um, I don't think the current administration wants American companies to fail. A lot of this could be negotiating, what they're doing now with tariffs. But um, some things to keep in mind is we have a lot of deleveraging right now. A lot of companies forced to sell to meet a margin call. And that means whenever you have an ETF that's forced to sell, then you have good companies going down with the worst. And that could make it look like the stock that you own is going down for fundamental reasons, but it might not be. Okay. Quality stocks, they trade down to a peg ratio of 1. For instance, we have Google right now, it traded down to a fair value of 1 or less. Um, when there's a crash of 10 to 20%, there's usually a recovery of 10 to 20%. And that's exactly what happened in this past week. We had a 10% drop in the S&P 500, and it went up 5% soon after. So when you sell during a sell-off, you have to make 3 decisions: when to sell, when do you get back in, and what do you replace the investment with? And it has to be better than what you have sold, and to make up for any capital gain. So it's really hard to play the game of selling and buying at the low because you never know when to get back in. Um, okay, there's a couple comments um, that people think that the United States could be losing its safe haven status. And that's a major problem because we financed a lot of our global ambitions, our wars, and our um, military based on borrowed money from other countries. And now that could be coming to an end. And whenever there's not a lot of people buying your bonds, you got to raise the rates. And that could crush our interest payments. Okay, hold on. Okay. So I thought it'd be interesting to go over a stock screen. We have some interesting, what I do is I sorted based on forward EPS long-term growth. Um, Sometimes these aren't right, but I thought it'd be interesting to go over 2 stocks. One is Chewy. They make toys and for your dogs and cats. Um, However, they've been expanding into other areas such as prescription medicine and other things. So we're going to go over that stock. We're going to go over Freeport McMoran. The reason I thought it'd be interesting to go over Freeport McMoran is a lot of the commodities are going up in price recently because of the dollar going down. And Freeport McMoran is I think is one of the world's largest producers of copper, and they also produce gold. So we saw our gold miner going up today in the top 10, Newmont Mining, or is it Newmont? So we have, so I thought it'd be interesting to go over FCX. And of course, we see Eli Lilly, they're growing at 41% according to this, and they're 1.5 peg ratio. So that's still overvalued. And we have Netflix and Progressive as other stocks that are interesting. All right, let's look at Chewy. Chewy has a market cap of 15 billion. Their forward PE, according to Yahoo Finance, is 39.8, and their PEG ratio is 0.49. So according to Yahoo Finance, they must be growing at 80%. I don't think no. That was last. They're at PE of 28, so they're growing at like 60% according to Yahoo Finance. PEG ratio of 0.35. That is just amazing if it's true. The profit margin, this is very concerning, is 3.31%. That's very low. Their margins are very thin. In other words, if they get some dog bowls from a manufacturer in America that cost $1, they'll sell them for like maybe $1.10. So they have a markup of 10 cents on $1 item. That's where you get really low um, profit margins. That's an example of a profit margin. Now, the return on equity is just amazing, 101. So there's a little bit of hope in this. Total cash, total debt counterbalance themselves. So they have no debt. And their levered free cash flow is 340 million. So they're a profitable company. So let's go look at their numbers. I look at their year over year. They're actually losing 27% from this year to next year. And they're growing at 28, 32%, and then 1% after that. So it's very inconsistent earnings. So this could be something that I wouldn't be interested in just because of that, because you're going to have a different earnings every quarter. And they have low reliance on Chinese imports. They actually went up 7% whenever there was a China tariff relief. So the market just looked at Chewy, knows that it's dog roped from somewhere, maybe probably China, but it wasn't. BofA has optimism on the stock. So this company's actually been on a conference call that said only 10% of their goods come from China. So they're insulated from China issues, but they might go down with the market because people think that they're buying all their toys from China. All right, that was a good little exercise. Let's look at the Morningstar information. They said they think the stock is fair valued at 1 PEG ratio. Let's look at the report on CFRA. They say that it's a strong buy. They say they have a long growth runway as it expands into new verticals, healthcare, ads, and insurance. So that's how they're growing. And they're they're encouraged by the sequential growth of active customers. So that means once they have a customer, they end up buying more and more from the same customer. Okay, let's look at CFRA. They have a strong buy, and the fair value is 43, which is undervalued by 36%. So they think Chewy is pretty good too. The only issue right now in this environment is when there's big jumps and big drops in the market, this company will definitely go with it because it's it's like a cyclical company. Whenever the economy is doing good, it does good. When it does bad, it does bad with the market. Okay, we already looked at that. Let's look at Freeport-McMoRan, the copper and gold producer. I looked at their earnings estimates. They're actually expected to grow 13, 38, 20% in the next couple of years. So that is, let's say, an average of 20%. And that means they're fairly valued at 20 because um, you have average growth of 20%. And their PE is 20. So it's a fair value of 1, a PEG ratio of 1. Okay, so let's look at Chewy's chart. You can see this is another stock that is actually winning. You can see it's very well in its range right here of expected outcomes based on these charts. So this is a very predictable stock. It's missing a couple numbers that I would want in the statistics. Um, and it's a smaller company. So whenever there's worried about the economy and there's a crash, it'll go down with that economy stock and retail stocks. Okay, there was an article here. I got 2 links here you can click on. Jeffrey Dunlop is basically a bond master. I think you call him a king. He's basically sounding some alarms that there's a huge problem with the United States debt. He wants people to have at least 30 to 35% in cash right now. He said that there's over a 60% chance of a recession. The CAPE ratio is a cyclically adjusted PE ratio is 35. That's one of the highest of all time. He thinks the S&P can go down 15% from where we're at right now. And he's a really smart guy. He thinks there's forced liquidations on treasuries. Um, so we have to watch out for any um, drop in the stock market based on something that might not um, actually be real. Okay. Okay, this guy's been pretty spot on, Michael Guyad. He's um he's been talking about the reverse carry trade, and he thinks that there's going to be a squeeze where people are forced to have a margin call, and they have to liquidate positions. So if your stock goes down in a major way, it's it could be not due to um, fundamentals. It could be very well due to forced liquidation. And he sees it. He said right now, Japan used to be surprise attack on Pearl Harbor, and now it is the rising, it is, wait, and now it is the rising interest rates. Okay, so he's basically saying as the yen, the Japanese money, interest rates go up, um, that'll make people force sellers of their stocks. And that's going to be a catastrophic um, crisis. So we have to keep that in mind and be very defensive when you're investing right now. All right. So that is what I had to say for today. I hope you really enjoyed that. If you have any questions, let me know and I'll answer this for you. Okay, have a good week. Good luck.